There we go. Want to welcome everybody to the How to Make Money Trading Stocks webinar for Friday, the 10th of February 2017. We have been living in some very exciting times here lately over here in the United States, and Michael, I'm going to be asking you a question later. Michael, you can be thinking about this. Michael Bishop is joining us from Switzerland, and then Mike Traeger is joining us from Dallas, Texas. Michael, I'm going to be asking you a question with regards to how the what's the view of the current administration to the Europeans? The current administration has been in for about 3 weeks. You can think about that question. We'll come back to that when we get into the market review. So Michael, welcome. Mike Traeger, welcome from Dallas. How are you gentlemen doing?
Well, good morning or afternoon, depending on where you're at.
Yes. I want to remind everybody that all the materials we do present are for training purposes only. Traders should always paper trade any new method, part of the risk of their own personal capital. Here's Michael's disclaimer from, if you want to get a hold of Michael, here he is over, here's his email address, and this is his disclaimer that's required for European trading. Michael, is this blanket across the whole EU?
No.
Or just specifically for?
Well, I mean, I'm not a lawyer, but this is from Switzerland, and it's, I think, close to the European community, but not. Well, I even don't know. Maybe every country has a different one.
Okay. Here's a little bit about who I am. The motto for the active trend trader is one we always try to clarify, simplify, so that we can multiply our holdings. Started trading for a living back in 2006, but started my education in the avenue of technical analysis back in 1989. Back in the days when you had to download your charts via a telephone modem, and you could only get like 30 or 40 stocks at a time, and it only went back for like 2 or 3 years. And I was living in the Bay Area at the time, and it was so wild to download and had to import all our data into a charting program that did not have nearly the bells and whistles that our systems now have, our systems have today. So I am a very big proponent of coaching, teaching. Matter of fact, somebody asked me, what is the makeup of the active trend trading? And I said, basically, we focus probably about 60% of our time on coaching, teaching folks so that they can eventually, so they can, in fact, just, fish for themselves. We do provide a great watch list made up of leverage ETFs and IBD 50 stocks that float up to the top after each one of our yearly, weekly sorts, And so this coming Wednesday evening, February 15th, we'll be doing conditional orders and target shooting entries. This is a crucial piece. We've gone through and laid a really great foundation for the active trend trading for the members of the premium members of the active trend trading service, and now we're just continuing to refine, continuing to work on making it better, continuing to help people identify, okay, if here's a stock I want to get into or an ETF, where's the optimal point that I want to buy a position, because there are, basically there are only 2 things that we control when we are working in the stock markets. We can control when we want to get in, at what price we want to get in, and we can control when we want to exit. And that's either with a stop loss and or our profit targets. What happens in between, we have no control over. Mike, the last time you tried to control what the market was doing, how'd it go for you?
Is that directed to me?
Yeah.
Oh, the last time I tried to control the market?
Yeah.
It didn't work out real well.
Yeah. And I know Michael, when he was popping online, getting online this morning, was not voicing frustration, but voicing, oh my gosh, just having some challenges because of the way the market's been reacting to the last week or so. Is that right, Michael?
Yeah, it is. It is. I really had a better time. I mean, my focus is on premium, and if you have the combination of a bull market with no clear signals combined with not much premium to sell or to protect your core positions, it's a pain. And as you said, stay mechanical, stick to your strategy, and all the other things don't work.
And so, yeah, that's one of the things. Matter of fact, at our Bay Area Moneymaker meeting this last Saturday there in San Jose, California, we talked specifically about the concept of of staying mechanical. It helps to eliminate a lot of the emotional issues that most if not all traders have, and so yeah, very critical. So hey, this week new highs. We're extended again. That seems like a repeated theme since the beginning of the year. S&P has pushed up to new highs. The NASDAQ has pushed up to new highs. The Russell continues to lag a little bit, but it has not broken down yet. So the question I have regarding the market is moving into the midsection of February. We've been aware of the historical norms that are expected in a post-election with a post-election indexes. Will those kick in? And if they do kick in, we should expect a pullback soon. Now, how deep is the pullback going to be? In the past, that pullback has been anywhere from 4 to 6%. Countering the historical norms right now is optimism is still very high, yet the markets are still very overvalued. Mike, have you done some checking here lately to see how overvalued we are?
Well, I've been speaking for weeks and months about how overvalued and even overbought the market is, and the more it goes up, the more overvalued it becomes. Depending on what valuation metric you would like to choose to measure, historically where things are at in terms of valuations, there's a case to be made that the stock market overall, when you look at the S&P 500 or the Dow or even the NASDAQ, well, let me take that back, not so much the NASDAQ. The market is the most expensive now it has ever been in history, ever. Even more so than 2000, even more so than the big crash in 1929, more expensive now than it.
So more expensive than even back in 1929, and also going to 1999, going into the year 2000 when the market went into a significant downturn. David says.
Yeah, well, like I said, depending on which valuation metric you want to look at. If you want to look at trailing PE ratios, it might have been more expensive in 2000, but if you look at some other valuation metrics, it may be a little more accurate and less likely or not as easily manipulated. Some valuation metrics, we are now the highest we have ever been in the history of the U.S. stock markets.
Oh, good. I don't know if you guys heard. Did you hear that ka-ching sound?
Yes.
Okay. Well, that means we just hit a profit with IDCC, a stock we got into a couple of weeks ago, and so we took 5% off the table. I like it before it goes into its its run. We made that adjustment for premium members. I hope everybody got that email. It adjusted our target 1 position to take off half a position at the 5% mark. And so David went long UPRO on 131 at the end of January. He's up 5.5% on a half a position, and he's inclined to take his gains sooner rather than wait for further upside. You know, David, I have no problem when somebody takes off a 5 to 7 to 10% gain, you know, takes off at least half of the position. You know, pay yourself as the price action moves up. And and that's, you know, I have no issue and no problem with that whatsoever. I know some, you know, I think that sometimes we can shoot ourselves in the foot by taking profits too soon. But if you've been hanging on to that for 2 weeks, it's up 5.5%. You know, restacking, you know, re-racking the pins and getting ready to bowl the next frame on the bowling alley. There's no issue with that. What about you, Michael or Mike? What about taking partial profits? You guys got any problem with that?
No.
No.
Okay.
But on the other side, I try to be very small most of the time. So so rather than kind of, if I have a trade idea, I prefer to go in maybe twice within 1 week instead of once, and so also the profit taking is step by step and not in once normally.
Yes. So basically you pyramid in and then pyramid out.
Yeah.
Okay. Yeah. I mean, I think that's a great way to approach things. Hey, here's the stocks, a percent of stocks on the NYSE above the 20-day moving average. As you can see, it is basically just, you know, moving here between 40 up to, you know, maybe 70%, and not really moving. As we've highlighted this several times, this is an indicator that Mike Traeger had been utilizing for several years. We adopted this into our early warning as one of the early alert triggers, and we're waiting for, we find that we get the best results when this indicator gets down here below the 30 level. The lower it gets, the better, and typically the higher the bounce from there. And as you can see, so what I like it in this particular avenue is where, you know, this portion down here, there's nothing to act on, but we can see that, you know, the percentage of stocks above the 20 on the NYSE is below 70%. However, the S&P, as reflected by this line chart, and this reflects the spider, continues to push on up to higher highs. Now, and when we look at the chart of the S&P, which we'll be doing here shortly, you know, I would like one of you two to comment a little bit about these, you know, fairly significant moves up, strong moves up, but really fast moves up. And if you go back here to November, just prior to the election, you got a really strong move up. The S&P went up about 8-9% in a very quick period of time. So when we get to the S&P chart, I'll be asking you guys that question. Mike, anything here that you want to bring to everybody's attention?
No, not really. I mean, you know, this thing's kind of been in no man's land for the past month and a half or so.
Right on.
Not presenting any actionable information, at least not for me, since early November.
Okay, good enough. And so,
but maybe a reason for this is there've been now a lot of earnings. Plus, oil was pretty weak, and some tech companies disappointed, and then there was kind of a quick they fell, and then there was a quick rebound. So maybe also this makes the picture a little bit shady.
Yeah, and if you go to the www.barchart.com, you can actually take a look at this, but this particular chart, which is the $MMTW on a daily basis. And what's a lot of fun occasionally is to go back in time and look at it in yearly snapshots and see in the past where you got this kind of action, and then go look at a picture of either IWM or the spiders or the Russell, the S&P, or the NASDAQ to see during this type of action what were the indices doing. It's a good training exercise just to get familiar with what's going on. So let's see here. As about 9 o'clock this morning, all the indexes are up for the year. The Russell has not gone above its high from 2016. We have continued with the active trend trading to kind of continuously plug along, and so quite pleased with where we're sitting right now. And so let's take a look at the charts. Just see. Oops, I don't want that chart. I want that chart. So the S&P, it has, again, broken out above the 2300 level. Over the last couple of days, it had pulled back below it a little bit, then popped back above it. And so we have another breakout. What does this tell us? It basically tells us that, we're in free sky territory. There is no past resistance above our current price action. So does that mean it's going to go completely to the to the moon? Well, no, not necessarily, but it does mean that the uptrend, which we see here, this uptrend that has been going on now since the first part of November, is still intact and still moving up. And basically, as long as this approximation of the uptrend remains where it's not broken, we can expect price actions to continue to move higher. What are the TSI has broken out back to a high, so it may be going to push on up above the 50 level, where it tends to then kind of soften up and price action move. Last couple of times you got a nice pullback here, got a sideways move and a pullback over about a 2.5 week period from this high when it was above the 50 level. And so if we push on higher from here, which I don't know how much higher we're going to push, but we are getting a couple of things extended away from the 8, the 20, and the 50, but all the moving averages are pointing in that direction. So the uptrend is intact. Prices are getting extended away on the weekly chart above the 8-week, above the 20-week, and above the 40-week. 40-week moving average approximates the 200, the 20-week, the 100, and the 8-week approximates the 50, but not quite exactly. So, guys, any comment on the S&P?
My only comment is that I am almost on a daily basis stunned at what's going on.
Okay.
Yeah, me too.
Now, Michael, oh, go ahead, Mike.
No, I was just going to say, as you've pointed out, there's just absolutely no resistance here, and this is a market that just is not being allowed to correct.
Yeah. Now, how much? I mean, do you think this is still the Trump enthusiasm regarding lower taxes, lower regulations that'll be more positive towards business growth?
Well, yesterday, yeah, I do believe that in a nutshell. Yesterday, I was looking for a reason why yesterday happened, because it was such a big up day.
Yeah.
And you should know, if you don't know, that a lot of the the trading now, the daily trading is computer driven.
Right.
I think it's 80% of the trading on a day in, day out basis is computers trading with each other, and they are programmed, they have computer algorithms that are programmed to scan headlines and key off of certain words. And so yesterday, apparently, in one of his tweets or one of his interviews, something came out that had the word tax in it.
Right, right.
And if you look at an intraday, like a 10 or 15-minute chart of the indexes, once that word tax came out, everything took off like wildfire, and so far hasn't really looked back. And so to answer your question, yeah, but I believe, it's not people like us, jumping in at this point to buy things. A lot of it is just triggered by computer algorithms scanning headlines, having been programmed to react to certain things, and then taking off. And I think that's what we're witnessing here, especially the last couple of days.
So, yeah, and Michael, I'm sorry for cutting you off. Go ahead with what you were going to say.
No, so I totally agree, and maybe another factor is the huge amount in percentage of passive investment. I mean, if the Nasdaq goes up, then and Apple doesn't go up that much, then next day X large funds and large pension funds, national banks or whatever, just buy Apple to catch up.
Okay. Are we, one of the things I'm thinking about is that, a lot of funds are still, a lot of dollars are, flowing in, a lot of money is flowing into the market right now. I'm not sensing at this point that there's a euphoric type of mindset, or that people are scared that they're going to miss out yet. Not saying, that doesn't seem to be paramount in people's mind right now. But, at some point, those of us who were around back in 1998, 99 with the craziness there, going into 2000, it was like, there was almost like panic in the street where people were afraid they were going to miss those moves in those .com companies. So we haven't got to that yet. Yeah. So now.
Yeah, but we could little nice story. I think last week I attended a little finance exhibition in Zurich, and there was a little quiz, and you could win a prize. And basically, all you had to do is to say that they took some index, a special index, I can't remember, and they ask you where this index is end of the year. And of course, I have no idea, but just to guess to pick a number, I entered something like -10% or -5% or something like that.
Yeah.
And the guy looked at me like I would be crazy. Basically, I'm the only one in this today who bet on a lower price instead of a higher price.
Oh, that's wild.
Yeah.
So.
Yeah, I absolutely believe that, and Dennis, I would respectfully tend to disagree about the lack of euphoria in the markets.
Okay.
I believe it's certainly there, and I believe it's been there for a while. We just haven't yet had the trigger event to turn that around. I believe everybody I see and talk to is on such a high about the way their investments and their portfolios are performing. And they see no end in sight, and I think personally, it's my opinion that there's quite a bit of euphoria out there.
Okay, well, no, that's good. And that's why it's wonderful having both you and Michael on board for these Fridays, because we're each at different locations around the world to get a flavor for here's what I'm seeing, here's what I'm seeing. Yeah, because unfortunately my home web page is MSN News, and since the election, you would have thought you would think that the world was coming to an end by listening to MSN. The only reason I do that is because I want to know what the enemy's thinking. Anyway, but we won't go there. So hey, guys, just real quick, and I think we'll see this is evident on the NASDAQ also. It's just these robust moves up. Pulling back to doing a nice flag pattern, zooming up, pulling back, zooming up. I mean, the market's done that kind of stuff before. But this, as we know, this can't go on forever, but a lot of times it can go on longer than you think.
Yes, it can, and then in fact it already has.
So I got a couple of things. Yeah, TDS, I know, David, there's a lot of that out there. David says basically that he would look forward to a 20% correction, and Joe brings up also that if it's if it's not full-blown euphoria, it is at least absolutely no fear, and you can see that by looking at the VIX. VIX is a very yes.
Yeah, actually briefly, I think it was a few days ago, and I think it was intraday. Actually, went below 10.
Oh wow.
I don't think in the history of the VIX, ever since it was established, I could be wrong, but I don't think it's ever gone below 10 ever in history.
Yeah, so that is kind of wild. And so, okay, NASDAQ. NASDAQ has been, it reacted a little bit differently after the election. It did a real more significant pullback, but once it came back and hit off this 50 on the 30th of December, I mean, it has rocket shipped out of this low here, and has actually run up about almost 7.8% or so from that time frame, and over a period of, let's take a look at the period here. Looking at a period of approximately 29 trading days or 42 calendar days. Excuse me. Again, no sign that it wants to turn around. It's doing, as with the S&P, we won't trade it when it's up here. I won't go short on it when it's up here, but we will have to just wait for the pullbacks to pull back into a moving average or to a level of support, and then it rocket ships away from there. Is the anticipation. Now, on a weekly chart, we are getting up over the 40 level, approaching the plus 50 level, which oftentimes with the NASDAQ is the place where it, let me pop this up, as is the place where it gets up here. It can get up 70 or so, but at this time, no negative divergences whatsoever, and we're just continuing to it's just continuing to push higher. I popped that out to a longer time frame so you can see where some of the past peaks have been, and it doesn't often get much above the 62, 63 level on a weekly chart. Similarly over here on the we are getting a little bit of negative divergence on both the daily momentum and the True Strength Index, but no reversal candles as of yet. And Michael reminds us that the market can remain irrational longer than we can remain solvent. That's why we do mechanical trading. So anything on the NASDAQ, guys?
Just seems to be getting ahead of itself.
Yeah.
When you look at the the air or the space between price action and the moving averages, both on the daily and weekly charts, as you've already pointed out.
Okay. Russell.
Just a question to you guys. I mean, January is usually not a month I thought with a big uptrend. It's more a consolidation of December, and February is, I think, historically an underperforming month.
That is absolutely correct.
But not this year.
Not this year yet.
Not this year may be the exception that proves
Or,
the rule.
in other words, can you remember that we had such a boom starting of the year?
You know, I can't remember where there was such a strong rally as strong a rally after an election as what we've seen since the 9th of November. Now, the historic charts tell us that no, that tends to happen a little bit, but I don't remember one as robust as what we just saw. How about you, Mike?
No, you know what, and as you're having this conversation, I've pulled up kind of a weekly chart for the S&P going back 4 or 5 years.
Yeah.
And going back 4 or 5 years, I mean, the Januaries and the Februaries have been pretty weak until now.
So, okay, here's the Russell real quick, guys. It appears as if the Russell may be breaking out of this trading range. It still has some resistance up here at the 1393 level, but we bounced off the 50, made a nice rebound over the last couple of days. It has basically been going, you know, just sideways ever since the 9th of December. But it looks as if the TSI is starting to perk up a little bit along with the momentum. On a weekly chart, it also looks as if that as it's pushing on higher, that the TSI has started to turn up, and momentum has started to turn up. Although as we push the new, this would be considered a negative divergence. But if it really explodes out of here, the momentum in the TSI will start to take off. It too, now the January, February, March timeframe for the Russell tends to be its weak months of the year, and so I think it is staying closer to what would be a historical pattern for it, and so. But if it gets in gear and starts really pushing up, then we could have all the indexes in the same, all in sync with each other, pushing on to new highs. I think eventually at some point the evaluation that Mike was talking about will kick in. We just don't have a clue when that's going to be at this point, and the market can move a lot higher before it kicks over and starts to drop like a rock. Anything on the NASDAQ or on the Russell, guys?
No, but I do have a comment on the Dow that I've been dying to share with somebody for about a week and a half.
Let me get the Dow up.
Well, it's more of a historical perspective thing, not a thing.
Go right ahead.
Well, for anybody listening in that thinks that things are getting crazy and thinks that the idea of being able to make money on the downside is exciting by shorting a market, and I used to be like that. I'm not like that anymore. And let me tell you one of the reasons why I am not like that. I mean, we all know with these indexes that stocks are added to and subtracted from the indexes all the time.
Correct.
And the Dow is especially influenced by that because it's only 30 stocks. And so I was reading, an article last week, and to be honest, I have not gone back and independently verified this. I don't even know quite how to do that. But the gist of the article was The furthest back you can go would be to 2004 and look at the 30 stocks that were in the Dow in 2004 and still have those stocks available on the exchanges to be bought and sold currently now.
Right.
They're no longer, some of those stocks are no longer part of the Dow, but they're still out there and they can be traded or invested in. They have not disappeared or been merged away or taken private. So hypothetically, if you were to take those stocks at their current values and go back to the composition of the Dow index in 2004,
okay,
their current prices, and we know that the Dow is a price-weighted index,
right,
not a cap-weighted index, but a price-weighted index, and you take the current values, the current price of those 30 stocks, and you put them together as they would be in, making up a Dow index today, and look at the overall valuation of what that would be. And it's kind of a useless exercise, but it's kind of interesting or fun to look at, because this author of this article came to the conclusion that those 30 stocks, if there had been no changes in the Dow index since 2004, and those 30 stocks were still the Dow would be around 13,000 right now.
Really?
Yeah.
Huh.
Yeah. Now, again, I have not gone back to double check that or independently verify that myself, but I thought it was a really interesting thing to read. And why do I make that point? Because there is a built-in upside bias to the U.S. indexes that is it's an intentional attempt to keep them elevated by occasionally substituting in stocks that are just basically, higher priced and considered better performing than some of the laggard stocks that they want to get out of there. And that's why I'm no longer interested in shorting the markets. There are forces in the universe against the indexes wanting to go down, and this is just an example of that in my mind.
Cool. Oh, that's very interesting. Hey, Mike, if you can, if you still have access to that article, if you could provide me the link, I can shoot that out to people, anybody who would be interested in seeing that.
Yeah, I'll have to take a look. I didn't really save it, and I'd have to sort of do a search to go back and try to find it. But I promise you, I'll give it a go.
Okay, awesome. And so let's move on to the rest of what we're looking at. Okay. Now, I've been showing this chart every week now for several weeks. Okay, this was a chart. Mike, I think you sent me this chart, or Michael, one of you two sent me this chart. I think it was you, Mike, and or I found it on my own. I can't remember, but it basically covers the market in days, in trading days, and it goes back 65 years, and it shows every time there was a change of party in the White House, a new administration came in, all the way from Eisenhower through Obama, that this was kind of the shape of the market. A real strong run-up into the inauguration day. Here's the election back here, inauguration day, and then for about about 2 weeks from there, it's about 10 trading days after the inauguration. Now we're past that time frame, but around that time you would hit a high, and then the market would bleed off, losing from 105 down to 102. I think this is in percentages over here in the ranking. So whatever that 2 or 3% that it would drop, and then go back into kind of a sideways movement for out 120 days from the election. I bring that to everybody's attention because we are approaching the time where it has peaked in the past. part of my concept and my thoughts is that history, tradition, has some weight in what the markets will do, primarily due to condition of people to, okay, this is when we expect the market to fall, and therefore it becomes a self-fulfilling prophecy. Now here is another seasonality chart. The pinkish line, it reflects just 59 years worth of data that finished in 2009, which reflects the average return on the S&P always being around 8%. Michael, here is what you were talking about with the is that typically February tends to be a down month. But as you can see, the blue line is post-election. That is the year after the election, the year that we're currently in now. It itself tends to run a little bit sideways, pop up into the first part, mid part of February, and then go into a drop of about 1.5 to 3% to the downside. Move sideways until we get into 401k, IRA investment time, and then pop up a little bit sideways. And as you can see, I'll start filling these in with some dots. That's a low point, February, and also a big low point in October. And this consolidation period that runs about a 2-month period, pop up. And so, so what I'm looking for is confirmation that the historical pattern will basically be replicated again this year. We haven't seen it yet. May, and as Mike said, may not happen. There's a lot of forces at work out there right now that may just negate this completely, and we may get an outlier year. I mean, you get outlier years. It happens. But it's an interesting concept that typically, okay, February hits the midsection of February. By that time, the 2-week, 3-week, 4-week honeymoon period with the new administration is over, although it's questionable whether this administration really had a honeymoon period with all the opposition that it has faced. And so, but the market, even though there's all the political turmoil going on currently, the market has continued to chug higher, chug higher, chug higher. And so just something to keep in mind. And again, I'm looking to see, will history repeat itself? And at this point, and so, yeah, one side, no honeymoon period this time. One side went directly to divorce court, yeah.
Yeah, I think the honeymoon period was after the election, not after the inauguration.
Oh gosh, I tell you, one thing in my brief life, I have never seen the craziness that has happened over the last, since the inauguration. Absolute. It's very interesting. So, but if you've never seen this chart, please. If anybody wants a copy of this chart, just email me, and I'll be glad to send it to you. But it's very reflective, and again, it's not a 100% guarantee that this is the probability this is what's going to happen, but the weight of history is on favors it, and so what I'm looking at is if we do go into a pullback period that happens to be in this area. This is where we want to be looking at, okay, let's get ready to buy. That's, this is what this is really, this chart, both of these charts is really good for, is that, okay, and when I was doing my research on the IBD 50, over the past 10 years, I saw this work out in the growth stocks, where typically in February, March, you would get typically the low points on the first IBD list of the year. then it would go on a nice spurt, and some of those spurts were in excess of, 20, 30, 40, in some cases over 100% in a very brief period of time, and then cool off a little bit, going, coming out of the summer into September, and then pick up and kick off in October again and run up. One of the things to keep in mind is that the Russell outperforms historically the other indexes during this period from latter part of October, mid-October through the end of the year. And so just keep that in mind, tuck that away, write that in your make a note to yourself on your smartphone calendar to get a reminder, so you can say, oh, okay, here's my reminder. The Russell tends to perform best, and have it shoot to yourself around the midsection of September. So, okay.
Yeah, that's assuming that there will be a period of selling before into a bottom before those runs begin to happen.
So, okay, Mike and Michael, path of least resistance.
At this point, I have to say sideways with an upward bias. I mean, there's no resistance except for the Russell. There's no resistance here on any of the other indexes.
Okay. Longer term, 3 to 5 years, you're still over in this camp, though, yes?
Absolutely.
Okay. Michael Bishop.
Actually the same, but 3 years is too much, I think, because it can go into the other direction that fast, and yeah.
So you think
long term? So I would even dare to say in 1 or 2 years we have a much lower index.
Okay. Excellent.
Thanks. Yeah, I would kind of agree with that, and I'll tell you why. And it gets back to election cycles and presidential cycles. Almost invariably, without fail, and I'm not talking about necessarily a new president or a change in parties, the third year of a new, the third year of the 4-year presidential term,
right,
invariably over the last 100 years has been a very positive year, almost without exception. And in order for the third year of the 4-year presidential cycle to be positive, I mean, there has to be something negative happening before that. And so I would tend to agree with Michael's statement that, something's got to go down in the next 1 or 2 years for that third year to have that historically positive bias.
Okay. And so for me right now, I want to be trading the pullbacks for the bounces to the upside. I agree that, I know that eventually the inertia of the evaluations will take effect, but how far out, I haven't got a clue. And right now, the market, the intermediate or the immediate short-term aspect is I want to basically be trading the pullbacks until they stop working. So there you go. You have 3 different perspectives that we all kind of eventually wind up over here. Just the time, but in the interim, while we're waiting to for this to take place, we have to stay with the trend that the market is giving us. So let's wrap this up, folks, because I've got to get back on to the final hour. Here's where we're sitting so far this year. Now we just had I know that we IDCC triggered out, so we'll have a positive for February in strategy number 1. And just a reminder, everybody, I'm a very big proponent that a person has got to have a strong system in place before they start adding the strategies to it. We try to keep it simple with the active trend trading so that you'll learn the system, focus primarily initially on strategy number 1, and then add in strategy 2 and strategy 3 as you become proficient with the system. And then here's some of the things that we're doing this coming Wednesday night. Well, first, BAM, we will have a Bay Area Moneymaker meeting the 4th of January, Trading Psychology 101. This coming Wednesday night, conditional orders, target shooting entries. We've done some refinements in the for the premium members in the videos. I'm really glad to announce that my youngest son, Brandon Matthew, is going to kind of take over the portion of active trend trading that has to do with the training videos and all that kind of stuff, so it's going to really streamline that a lot. And then lastly, I've revised, the trader report comes out on Mondays, but if there is a setup that's that's evident after my weekend review, I'll put out an on the radar report. It's shorter but actionable on Sundays to all premium members. And then also doing live Facebook market updates and trading tech tips, and just enhancing the videos that we've been putting onto YouTube and to the website. So just a reminder that active trend trading is based on the 5 pillars of trend trading. We explain what to trade, when to enter, when to exit, what strategy to use, and what to expect. So strategy 3 is a strategy that I really one enjoy doing. We sell weekly premium on it. Here's where we're sitting as of so far in 2017. The Spider position is up about 7.7%. Tesla is doing the best of all 3. Nugget is just kind of like that slow grinder that's grinding up at about 13.36 since inception. So total gain for the year so far in strategy 3, about 22%. We adjusted our allocation to strategy 3, going from 20% of our trading capital last year up to it's about 26.6% now. So other than that, I do want to remind you that if you are on this webinar, I do offer a webinar special for members that can join and become a active trend trading member at 40% off the active trend trading. If you are a member of the early warning alert service, I'm going to be sending out an email this weekend just talking about just a refresher on what it takes to get a trigger, and a reminder that typically, Mike, 3 to 6 times a year is when we get a trigger. This year we have not had a trigger yet. Yes? Mike, you there? Mike may have.
Yeah.
Okay.
I'm here.
Okay. Hi,
No,
Mike. Yeah, Mike.
We lost Mike.
Mike bugged out. So, hey, 2017, still expecting explosive growth. So keep the egg growing. Trade wisely. Trade profitably. Please, if you want to be notified when the live broadcasts go on Facebook, you can go here to this Facebook page. It's www.facebook.com/activetrendtrading/. And for the Twitter feeds, you can find me at that Twitter address. So with that, I got to get ready for the premium member. Next is the final hour for premium members. So, Michael, any final thoughts?
No, it's fine. Thanks for having me.
Okay.
And just to very quickly answer your questions. I mean, in Europe we have an extraordinary situation. Elections in Germany, in France, and pretty a mess in the UK. So politics is more influenced by internal issues than the Trump election.
Ah, okay. So, is the I know the globalists worldwide hate Trump because he's a populist, but it almost seems like there's this division happening globally between populist, sovereign, sovereign country kind of guys and gals, and the one world order kind of folks. And it seems like that's getting kind of nasty worldwide.
Yeah, that's I think that's a valid observation. Yeah.
Yeah. Yep. So, but it doesn't change my concept on the market. The market is an uptrend, and I want to trade pullbacks. So with that, I'll say good day to Michael, and good day to everybody online, and we'll see you in about 5 minutes on the final hour. God bless everybody.
Okay, thank you. Bye.
Thanks.